Good afternoon, good morning, everyone. I want to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in the market. Today, we're going to start off with my colleague Elchin Mammadov, and we're going to chat about the tremendous rise in natural gas prices, whether you're looking at the US market, Europe, Asia. We're seeing this tremendous commodity boom unfold there. And we spend a lot of time on oil on this call typically. So let's start with the cousin of oil, natural gas. Elgin, how do you see the market dynamics right now, and where do you think we might be headed, particularly as it pertains to Europe?
The analysts are mixed in their outlook for national gas prices. As you said, they've come up quite strongly, especially in the past month or so. But the bull run started literally in 4Q last year. And yeah, it's not just in Europe, but it's in the US and Asia. So LNG prices are above their record seasonal high in Asia. In Europe, the front month TTF, which is a benchmark for Europe, is at all-time high. And in the US, the Henry Hub futures are at 31-month high the last time I checked. And this shows two things. It shows that thanks to LNG, the global gas market is becoming more interlinked. So Asia, Europe, and US are used to be like energy islands. Now they're a bit more interlinked. And but also the key drivers behind this bull run is the fact that the demand in Asia, especially in China, is recovering really rapidly. There's even a talk of energy shortages in parts of China at the moment. In Europe, Russia has been restricting its deliveries to Europe in order to get the Nord Stream approval over the board, and that has helped certainly. But also there've been some outages both on the in Norway but also more recently with Russia as well. So there's not enough pipeline gas coming to Europe, and LNG is being redirected to Asia. In the US, we're seeing bullish signs because of the really hot temperatures in Midwest and other parts of country. So yeah, it's all looking. It all explains where we got now. However, I am a bit more bearish for the evolution of gas prices in the latter part of the year, simply because I think the Russia is going to ramp up its exports to Europe now that the Nord Stream issue is resolved. Nord Stream will provide an extra pipeline route to Europe. They're talking about completion in the second half. I think we're literally looking at around, I don't know, November time, maybe. So just before the winter really hits in. So there are some bearish signs in terms of additional supply. The Norwegian issue of gas supply is probably going to ease off a little bit as well in the latter part of the year. And we've seen a lot of gas to coal switching because gas is so expensive now. It's a lot of the coal plants are coming back online, and that kind of eases the pressure on the demand for gas. But at the moment, the storage levels, particularly in Europe, are really depleted, and that explains why the gas prices have rallied so strongly.
Elgin, I want to talk a little bit more about that political dynamic that you just mentioned. So, do you think that this interplay, particularly with Russia, gives some buyer's remorse for the European Commission, the EU, in terms of Nord Stream 2? And is this perhaps a reminder that could accelerate plans to move even more quickly away from fossil fuels in general, particularly natural gas reliance, because of the reliance on Russia there?
I think Nord Stream is overly political, to be honest. But Europe is quite confident that it has enough diversification so that if there is some disruptions due to political or any other reasons on the Nord Stream 2, when it's going to be completed pipeline, or any other routes coming out of Russia, then we can have access to LNG. North African supplies have been really strong this year, and again, Norway is still decent supplier to Europe and a reliable partner. But what I need to say is that what Gazprom will always tell you, and it's true, that even during the Cold War and when the relations with the Soviet Union and the West were quite frosty, the gas flows were always coming to Europe. There was only one period during the crisis in Ukraine when there were some disruptions on the gas flows. But again, Russia has so far been quite a stable supplier of gas to Europe, and Europe is building more LNG import terminals like Germany, Croatia, and a few other. Turkey is expanding its own LNG import capacity. So the problem with LNG, unlike gas pipelines, it's not as responsive, and because it takes time for LNG tankers to come from where they're produced to Europe. And we are competing with Asia for that gas, but it is definitely a diversification of supply route to Europe, and Europe is quite comfortable. I don't think the reliance on Russia will define or accelerate Europe's shift to renewables. I think Europe's shift to renewables is going to accelerate because of net zero, full stop.
Okay, very interesting. Let's bring on Will Hares. Will's our senior oil and gas analyst. Will, I want to get your response. Obviously, the Integrateds are quite active in the gas space as well. It's a part of their portfolio. Is the gas run-up something that you're seeing have positive read across for their earnings, and how are they talking about this shift that we're seeing in the gas market particularly?
Yeah, thanks, Rob. So the tone from Europe's oil majors are very bullish on gas, and we started to see that benefit in the 2Q results that we've just seen over the last week or so. And as for the outlook, it seems very bullish as well moving into winter. Obviously, along with much more supportive oil prices, we've seen very strong earnings from across the group, really, and we've seen very strong operating cash generation, and of course, combined with continued strict capital discipline as a function of the big capex cuts made in the response to the pandemic last year. We're seeing very, very high free cash generation across the group, and this is having two main effects. One is bringing net debt and gearing levels down on the balance sheet to much more comfortable levels than they have been at. This has been a primary strategic objective for most of these companies. And second, it's prompting a higher investor pressure on increasing distributions. Of course, all of these companies, with the exception of Total, cut their dividend in response to the pandemic, and we're starting to see early signs of recovery, not just on the buyback side, which we continue to see management teams favoring, but also recovery of the dividend. We saw a big jump in Shell's dividend, nearly 40% increase at their 2Q results, alongside a buyback resumption, and same goes for BP yesterday. We saw an increased buyback and a marginally increased dividend as well. So these are all signs of, I think, very healthy backdrop driving this, with some of the releases giving credit to the OPEC Plus agreement, providing some price stability to the market. But I think we would note that this trifecta of lower spending, lower debt, and higher dividend and buyback distributions over the long term is not really that sustainable for this group, and particularly when you acknowledge that this group is increasing their capex into low carbon and renewable power generation businesses. These have much lower project returns than traditional oil and gas projects, and I think that really exacerbates this core issue that the group is confronting, along with climate and sustainability risk. That that the financial framework that they are being asked to deliver by investors at some point is going to have to bend. I think given the request for higher payouts and lower debt and lower capex.
And are you seeing any strategy shift based on the surge in natural gas price or commodity price generally? I mean, we've been talking for years now about the increasing capex dedicated to clean energy, but obviously it's a balance. And I guess the ultimate question that probably comes through with all of this is, particularly if gas is a part of your strategy, if you're an oil major, how long is the natural gas bridge? When they look out, do they have the confidence that both pricing and demand are robust enough to make those long-term investments that they've been mulling?
Yeah, so it's a good point, and I think I would say two things to this. First, not so much on strategy, but on tactics. Yes, Equinor is a good example of this. Norway's oil major. They have been increasing their flexible gas production volume from a few fields in the North Sea, and so they're able to increase or decrease production based on prevailing spot gas pricing. So they have been able to help capture value from the recent gas moves. But more strategically, we haven't seen anything yet. I mean, keep in mind that these strategies play out over multiple years and even decades for some of the large-scale projects, particularly large-scale LNG investments that are being made. But one thing I would note is that we are seeing a sort of more focus on these new projects that are being approved for them to be modular. So instead of say 10 years ago, when many of these projects were multi-billion cost, long lead time, take many years to develop from conception to being on stream, we're seeing a more modular outlook, and I think this helps provide more flexibility on spending. It's able to provide more flexibility in response to the macro environment. And so I would expect this model of development to be continued moving forward, particularly for gas, for those reasons that you mentioned, Rob.
Okay, I want to bring on Salih Yilmaz. Salih covers Aramco and many of the junior integrated oil companies in Europe for Bloomberg Intelligence. Salih, you've heard this discussion about gas prices. How does that feed into some of the companies you look after? And what do the national oil companies in the Middle East make of the gas piece of the energy transition narrative?
Sure, thanks, Rob. I mean, it's a very similar story to what Will mentioned when we look at some of the smaller mid-sized integrateds in Europe, where they are quite upbeat about the gas prices and in 2Q and the outlook for the rest of the year. When we look at Aramco does have gas projects, but as it stands, the majority of its production is very heavily biased towards oil. And I think for them as well, similarly, slowly they were planning to increase their gas exposure, but all these things that you mentioned is probably having them scratch their heads about the future of gas. And one thing I do want to mention when we look at Aramco reporting next week, and when we look at some of the mid-sized integrators that have reported last week, is chemicals. And this is one point that's been an outlier. I mean, we've been kind of highlighting the strength in chemicals margins since the beginning of the year, and this was one of the shining points for OMV. About half of their adjusted operating results, which was about 650 million euros, came from chemicals, and for Repsol, this was a very well-performing space as well. And when we look across the Atlantic, I mean, looking at Exxon's results, they also highlighted the very strong chemicals margins, and about also for them about half of their net profit, their bottom line, came from chemicals, and that was about $2.3 billion. So I mean, looking at integrates in general, very similar to what Will mentioned, and they're benefiting extra from this not so surprising but still better than expected chemicals performance. And I mean, this is very interesting. The other day, Shell CEO Van Beurden was asked on Bloomberg TV what he thought about what's going on in chemicals, and he said he was actually quite surprised in the continued strength in chemicals, and he said he is ambivalent of the prospects of it, though.
When you think about chemicals over the long term, what's the potential for biomaterials to come in and compete in that market? You know, chemicals can use all sorts of hydrocarbon feedstocks. So, is there any discussion about alternatives coming into that space as part of this conversation?
I mean, that's a really good question, and I don't think enough. I don't think we're discussing that enough. And right now, whenever we talk about oil demand, this is always the thing that's being brought up about what is going to be driving oil demand. Because, I mean, even when we look at year to date, the usual suspects like the road fuels, the jet, have been kind of struggling. But then the argument was that plastics, kind of lockdown era, increased use of plastics is an indication of the strength in petrochemicals, and it will kind of continue. But I think you're making an absolutely great point that looking beyond the next just few years, which again petrochemicals may continue to do quite well, I think there are some alternatives that may show up and kind of slow that growth that's supposed to be driving oil demand. And this is one of the reasons why we do remain a little bit more cautious on the longer term prospects of oil demand growth, despite this kind of hype that we have around the fast post-pandemic recovery that we're seeing in oil demand.
All right, and now I want to turn to Patricio Alveraz. We'll probably come back to all of you guys, but I just want to get Patricio's view on some of the readout he's seen, particularly from the gas companies in your coverage portfolio. So, Patricio, I think that you mentioned to me the other day that demand on the gas side was recovering a bit more quickly than anticipated for some of the European gas utilities. So tell us about what you're hearing and what kind of quarters you've been seeing for your space.
Sure, Rob. So I'm just going to talk about the European utilities, the gas pure plays, as we call it. So that's Italgas, Snam, and Enagas, which reported last week. What we've been seeing is a partial tailwind from an increase in gas demand with a very low comparative basis to the second quarter of 2020, obviously. So we've seen a strong recovery in gas demand, which sort of aligns with what Elchin was talking about the strong demand and just increase in gas prices. Though the benefit is muted, I'd say, for utilities in this space, given that they're heavily regulated, so most of their profits are already fixed. Nonetheless, we've seen a bit of a surprise on the earnings side, just small surprises on the bottom line. And just touching on the other side of things, on the other points, just regulatory risk for this segment keeps rising with rate cuts on the horizon that seem to be a bit larger than anticipated. So, for example, in Italy, most gas utilities expected a rate cut of about 30 basis points to 60 basis points, and the regulator seems to be pointing towards something that's pretty much double that. And I think more than what the outcome will be, which we will find out in December, this sort of tells you that utilities will be sort of more pitted towards renewables, and they'll get less rewarded, I suppose, for holding gas infrastructure assets, which continue to face this stranded asset risk longer term.
Okay, very interesting. Hang on, we'll come back to you. Elchin, I think this is a good place to bring you back in. What kind of narrative and readout are you hearing from some of the electric utilities in your space? Same kind of story. What kind of demand recoveries are we seeing on the power side of the equation?
I mean, on power side, the demand has recovered. Yeah. On gas side, it's declining this year again because I said the gas is just too expensive. So there's a lot of switching from gas to coal and power in particular. However, the key problem is that for utilities that, let's say, produce more power, less power than they sell, so they have more customers than they generate electricity. It's a good position to have, actually, most of the time. They are suffering at the moment because suddenly the cost has gone up because the prices skyrocketed. And as you know, the higher the gas price, the higher the power price in Europe. They go in tandem generally. And so the cost for utilities gone up. Again, for those that produce more power than less power than they sell. So it's a temporary issue, but that hurt their earnings this quarter. Yeah, and obviously as time goes by, they gradually pass on this higher cost to their consumers. It's a political issue, especially since everyone is still recovering from COVID. So there's a question whether the governments will allow the utilities fully pass the cost. I think most governments will. But yeah, some utilities are actually suffering from a sudden spike in prices. It will even out over time, but it just takes time to pass on these costs. On the bright side, utilities that were stuck with unprofitable LNG contracts, now that the LNG prices have gone up, some of those contracts are already in the money, those legacy contracts. So that's a good problem to have. So overall, higher gas and power prices are good for utilities, but temporarily some utilities are struggling on the earnings front.
Thank you, Elchin. Okay, I want to switch gears and move to the oil side of the equation. I know we normally spend much more focus there. Salih, you already were mentioning the demand outlook a little bit, but so gas has been on this incredible run here lately. Oil's been a bit more range bound, hasn't been quite as exciting. So I want you to just give us a quick readout. Where's the oil market at? We haven't even mentioned OPEC on this call yet. How's OPEC playing things in the market right now? And what's the 2H view on oil at this point?
Sure, thanks, Rob. I mean, sentiment still remains relatively positive. I mean, we saw this morning Aramco gave its OSPs for Asia for September delivery, and they raised all grade prices. So, I mean, I think they do see market tightening for the rest of the year. But that being said, I mean, the things that we're watching right now at in the market is demand, what demand will do. I mean, we talked about kind of the longer term demand outlook, but for the rest of the year, what demand might do. And again, I would like to highlight some risks. I mean, the last couple of days, we've been getting some Delta news from Asia, and that those don't really bode so well for oil demand in the second half. I mean, we are seeing cases rising. I mean, it's still a small number of cases, but cases have been seen in 32 different provinces in China, the second largest oil consumer in the world. And in China, generally, this does translate into curbing of mobility, and this obviously could slow down oil demand recovery in the second half meaningfully. When we look at India, that's the third largest oil consumer in the world. Right now, they seem to, I mean, in July, driving seems to have been back. They had very strong demand numbers in July, but experts are expecting another smaller, but still another wave in October. And again, we know from the second wave in India that does have implications for oil demand as well. And similarly, I mean, Sydney record cases. This morning, Indonesia, deaths in Indonesia passed 100,000. And again, in the rest of Asia, Thailand, Malaysia, it seems that more restrictions are possible. So I think generally the sentiment still remains pretty positive for demand, but I think risks remain. And I think demand is the main thing that we're watching at the moment. But at the same time, Iran is another one. We've talked about this on the supply side. I mean, we've talked about this quite a lot. And in the previous calls, when we talked about it, I think generally the tone in the street was very much that it's a matter of time for us to get an agreement. But things seem to be going not so great at the moment, and it's still not uncertain if we're going to get a deal or not this year. So obviously, if we don't, that would have implications on the oil market and the price as well, because I think the consensus is very much for us to get a deal and for the restrictions on Iranian oil exports to be removed before the end of this year. And the third one is OPEC compliance. I mean, I think we used to talk about this a lot more than we did in the last year, because surprisingly, I mean, historically, OPEC compliance wasn't really that great. But since the April 2020 deal, surprisingly, I would say we've had pretty good compliance. I think the group's compliance, overall compliance, has been around 100% for most months. But given kind of the troubles at the last meeting and some potential strains within the group, again, not something that's going to happen for sure, but at least we will be watching that closely and see if that compliance slips a little bit in the months to come before the end of this year. So that's really what we're watching in the market right now.
Very interesting, Salih. So with that, I want to turn to two pieces of thematic research that the team has worked on recently to close out the discussion. And we'll start with Will. Will, you have taken a close look at the Norwegian Sovereign Wealth Fund and essentially how they've been divesting some of their positions, particularly in the oil and gas space over the last few years. So tell us a little bit about what's happening there and what they're doing, and just give the folks a reminder, if they don't know the Sovereign Wealth Fund, what they are, what their holdings are, how big they are, that kind of thing too.
Yeah, thanks, Rob. So Norway's Sovereign Wealth Fund is the largest in the world. It's nearly $1.4 trillion. And so clearly it carries with quite a lot of significance with the portfolio moves it makes. And we've seen the fund over the last few years divest their independent exploration and production companies. And this was not unexpected. This was a decision that was made by the government and the Norwegian Central Bank back in 2019. But however, I think the really key part here is that it has occurred much faster than we anticipated, and it's a clear sign that these companies, these independent E&P companies, are really on a steep ledge from a climate and sustainability risk standpoint. And during our analysis of the fund's holdings, we also noted a concurrent average rise in ownership of some of the largest wind and solar companies over this same period, which suggests to us that while the Norwegian Central Bank and the fund had justified their decision to divest E&Ps from a portfolio diversification standpoint, we think it clearly maps very closely onto a climate and sustainability driven decision as well. And given the scale of these investments and the importance that Norway's fund has, we think that this could start setting an example or a trend for broader asset management, particularly as how they look towards some of these smaller independent E&Ps and their and the climate risk they face, given their inability to adjust their business models to offset their carbon profiles versus some of the larger oil majors, which have been spared the any divestment.
All right, thank you, Will. We were hoping to do a bit of discussion on a focus idea that Patricio Alveraz has published on Frontera, but he was in a conference room and he just got kicked out of it apparently. So we'll have to table that discussion for the next time we come together as a group. As a reminder, we hold these calls on the first and third Wednesday of every month. You're always welcome to join us and hear our latest views on the market and some of the research that we've published. So I want to thank you for your time today, and I look forward to hearing from you again in the future. Take care, everyone.